earnings tonight. Cerebras had their first set of earnings last night. The chips, what's going on? I've got Tim Colby on. He's going to be talking about the rotation he's seeing in the market, and he's going to be talking about the 3-step drop. His way of seeing when a trade is over and it's time to get the heck out of Dodge and maybe even short. It's going to be a great show. We got a lot of action for you, so let's roll credits, Amin. Good morning, everybody. I am Mark Sebastian, your only option. Welcome to the State of the Market show. If you're watching me on YouTube or X, please give me a like and subscribe. Give me a little heart, a little retweet, and better yet, email the team here, support@optionpit.com, and join the discussion live. Folks, yesterday, kind of a bloodbath. Now, we didn't end on the lows, but it was an ugly day, just an all-out ugly day for the markets. The S&P gapped down 100 and basically closed there for the day. QQQs actually had at worst an even bigger gap and then closed right near the lows. Just ugliness abounding. Today, little recovery. We have the SPX up about, call it 20 points. The Qs recovering about, 15.15%. The Russell 2000, the Dow, continue to look strong. You know, under the radar, the Dow was up yesterday. It was up yesterday, and it is up again today. And we saw the same thing out of the IWM. It gapped lower and then kind of rallied all day to not end on such a bad note, and then is rallying today. Part of what we're going to be talking about in a little bit is this rotation that we continue to see in markets. If you're watching oil, as all of you should, Brent is below 75, and you got WTI threatening to break 70. That is a pretty major move. I'm going to go to my daily here. And oil has given up everything it had, including a chunk of its initial gap higher when this Iran war started. The low tick on that day for energy was 69.20. Folks, we're 69.78 right now. And prior to the conflict, we were about 67. So oil may be closing that gap. If you're looking at the bond market, you know, it is up today. It does appear to be starting a trend higher. That would lend some support to the overall market. So that's kind of a nice win. And then in the news, we had two kind of big overnight events. Cerberus Systems. Now, this was the hot IPO prior to the SpaceX hot IPO. It initially opened on its IPO at $350, closed the day at $311. It's now down to $194. That is a post IPO low, and it's now approaching down 50%, down over 40 from the top. Just shows you what can happen in these IPOs. SpaceX, hasn't been around a while, but hit 150 about where it opened on the 12th and is hanging out right above there today. That 150 level and that 135 level are going to be two very important levels to watch. There's going to be some defense of $150 a share because that's where the IPO opened. And there's going to be major defense at 135 because that is what the IPO price was. And the issuers don't want the egg on their face of SpaceX falling below that number shortly after it lists as an IPO. So those are some things I'm watching today. As I look at SPX and the Qs, there's really only one part of these that I really need to pay attention to. Yesterday, and here's where we'll start talking about market drivers. Yesterday, SMH. An absolute bloodbath. The stock was down 7% at the close. We're talking, if this was a regular S&P future, it was this close to hitting a circuit breaker. For those of you who don't know, when the market hits enough panic, the CME has what's called circuit breakers. And that's to basically stop program selling from continuing to push things lower. Right? Intraday, if a algo or an AI trading system sees the opportunity to just push a short and push and push and push, it will. And so at the onset of program trading, CME after 1987, the CME installed circuit breakers to stop the S&P from completely falling apart purely on computer momentum trading. Well, I'm here to tell you that we got real close to something similar from this big, huge gap in SMH. And SMH continues to sell off today. It's hit a low. It's currently 615.73. It's been as low as 613. The level to watch is the low from the 16th. That was last Tuesday. And that low was 616. I mean, we're trading below there. That would, we get a little momentum under here. That's going to open up the floodgates. If SMH is going to be down, it's going to be tough for the S&P to stay green. Now, some things that could hold up the S&P 500 are the other Mag 7s. Google entering the Dow. Amazon getting oversold and maybe catching a little bit of a bid today. Strength in Apple, Meta. Not Meta today. Some strength, if we saw some strength in Microsoft. Those are things that could allow the market to hold a little bit of a gain. But chips have taken over so much of the market and now a prize such a big portion of the market. Right? They're nearly 25% of the Qs. And that means they're about 18 to 20% of the SPX. So we're starting to see some selling in SMH ahead of Micron earnings tonight. But that money's not completely disappearing. It's not. Yes, the chips had a very bad day, but there were actually more stocks up on Wednesday, Tuesday, than there were down. We're seeing a rotation. Here to talk about this rotation that we're seeing and how you can take advantage of it and what levers he's starting to pull is my longtime friend and head of macro analysis here at optionpit.com. He is Tim Colby. Good morning, Tim.
Mark, how you doing, buddy?
I'm doing well. I'm doing very well. Lot going on today.
Yeah.
They tried to rally SMH and it has rolled back over and pulled the Qs red. The S&P looking a little softer, but yesterday, as bad as things were, right? SMH down 7%. The Dow Jones was up. The Dow
Dude,
Jones
so
was
if you,
up most of the
yeah.
way.
So it's funny because I had been seeing risk wanting to get out of the semiconductors. What's interesting is that you and I both talked about this. We talked about money coming out of semiconductors, and we said it on Ticker Highlight Show, but we even talked about it Thursday last week. I think was when we did our write-ups. And I saw rotation, you saw some de-risking. The way you played it is you bought some SMH puts, you had some shorts in the Qs. I saw money rolling into biotechs, and not just biotechs. It was the little biotechs. It was the risk on sort of high beta biotechs. And so I bought the XBI, which is the equal weighted biotech index. And if you pull that up, yeah, I don't know if that's what you have. The XBI literally was up yesterday a chunk. So look at that 3-day chart. Like that rally is just happening, right? So my core view was that I'm long these biotechs. Your core view was that I'm short SMH. And rare on a day do you get two high beta stocks going completely opposite directions, and we're both right. And like the idea is not that was like lucky. It was like literally two expressions of the same concept.
Well, there you have it, folks. The trade you want to do is long XIB, XBI, and you hedge it with SMH. It's that simple, folks. No,
that's the trade you wanted to have on, right?
Yeah,
so at this point, I am exited most of these, but I was surprised. I had bought calls on Thursday, and yesterday I woke up, I looked at the news, and I thought, oh God, like the Nasdaq's getting cranked. I'm sure all these longs that I have are not doing well. And I woke up and I was up money on the open, and I finished up more money by the close because the money was rotating out of the SMH. They were selling the SMH stuff to buy other things. 8 sectors yesterday were up. 8.
Yeah.
Like the breadth was 3-2. So 3 stocks up for every 2 stocks down. You had consumer staples, which is defensive, was rallying. XLV, which is the healthcare, that is defensive. That was rallying. But IBB, which is not defensive, was rallying. Retail was up. The energy sector was up. The financials were up. Real estate was up. So you had like pretty broad rally actually yesterday, considering every headline I read was the market is getting destroyed. And I think you and I talked yesterday, and it was sort of like all I see is rotation. And I think you were seeing so much more de-risking. I think after our conversation, it was sort of like, all right, I see Mark's point of view. I was taking some stuff off the table because, there is a flavor of de-risking. And I think Mark realized like, it's not just de-risking. There's some rotation going through. So I think that's kind of the value add of a place like Option Pit, where you have, kind of different points of view and then helping each other out, figure out really what's going on through the markets.
Tim, have you ever seen the videos? They usually take place on a lake. It's like this big inflatable thing, and you've got a fat guy, like a 300-pound fat guy, standing on a ledge, and you've got a small child, could be a woman, could be somebody who's not very big, sitting on that inflatable. All right. So what yesterday was the chips jumping off that ledge, landing on that inflatable, and sinking into the lake. Meanwhile, the small child that was on the other end of that inflatable that got launched in the air, that was XBI. And so you're not wrong, right? We do see rotation, but chips have become such a large portion of the indexes that they can bring everything down even when we have positive breath. And until we see these indexes kind of rebalance themselves either through rotation or straight up special rebalance. That's what you're going to see when the chips are down.
Yeah. So what's interesting, I read the thing, and I got to give credit to Cameron Kreis on Bloomberg. I love this guy. He used to be a portfolio manager, but now he's kind of on their desk of writing about markets. But he put out something that's interesting. Micron Technologies. Do you know where it falls on the S&P 500 in terms of where it's at? Like the biggest
I know
stock,
it's now the
right?
it's the third biggest stock by weight in the triple Q now.
All right, so in the S&P, it's number is it number 10? I think it's number 10 or 11 in market cap.
Yeah.
So it's number 3 in the trillion dollar club, right? So it's 1.1 trillion dollars, which is a lot of money, right? So it's the 10th largest stock there. However, that's not necessarily because it's the 10th biggest, the 10th most impactful. Because how does something impact the market? It's based on how much it moves. Well, if you multiply the number of, if you multiply the market cap times its volatility, so how much it moves around based on how much value it has, Micron's the third most important stock in the world right now.
Yeah.
It's because its volatility is 100. It's literally more than 4 times more volatile than Apple. Apple's the number 2 stock, and Apple is 4 times bigger. Micron edges out Apple in terms of its importantness, and not necessarily important to what it can do, for society, but how much it moves the index around. So that's why, yesterday's move was so impactful on the S&P, because Micron's got 100 vol and its weighting is so high because its market cap is so high. So I think part of
it's moving $80 a day.
Yeah.
Which even on $1,000 stock, you're talking 8% daily on $1 trillion company.
So the next
moving 8% a day.
Yeah. So if you look at the list, I didn't make this clean. I should have put this in a spreadsheet to share. Anyway, the next stock below Micron is Berkshire Hathaway, also a $1 trillion company. However, Berkshire Hathaway has a whopping volatility of, take a guess in the chat. Anybody want to throw a guess?
It's about 1/10 of Micron. Let's put it that
1/10. So Berkshire Hathaway, which basically controls a gazillion companies and really good American companies, these are great, solid businesses. Not that Micron isn't, but like the impact that Berkshire has at $1 trillion in the S&P versus what Micron does to the index Micron's 10 times more impactful moving around. So if you go back to June 3rd and you pull up the chart of AVGO, Broadcom, that was a big sort of the first whiff that we had of maybe these things are fully valued, right? Because they had a good earnings, but they
had a great earnings.
They just took this stock to the woodshed, and it was like, okay, now to the woodshed means we're going to trade it a price it was trading 5 days ago. So like it had kind of a little head of the skis, and it came off.
It went all the way back to where it had been in April, basically.
Yeah. So Micron was printing a high yesterday, and then I think everybody's looking like, well, they got earnings coming up. Do I want to just fool me once with Broadcom? I don't really want to get fooled again with Broadcom. So with Micron, so you have Micron coming off into earnings. So like that edge of let's buy some puts in Micron right into earnings, because how could they surprise to the upside from here? So you're getting a little bit more less asymmetrical kind of a movement. But the rotation is real. So like if you look at the indexes today, the last time I looked, the Russell is kind of leading to the upside. And biotechs, again, we have this big rotation. You have, of the sectors, home builders are leading the way. You got retail is up. You have consumer discretionary is up. Biotechs are up. Industrials are up. Healthcare is up. I mean, it's almost every sector is up. X gold miners and the energy, obviously with WTI is sort of symbolic that it's printing a 6 handle. So 6 handle, meaning
Mhm.
it's down below $70. I think you brought that up earlier.
Yeah.
That's, that's the war premium bleeding out. And when I see this war premium bleeding out, that's people are looking at the rest of the market and saying, oh, well, what got sold from March 1st when the war started? And where are stocks relative to March 1st? That's one of the ways I'm looking at things. So just go through these sectors and look, all right, what got sold March 1st? And then just do a look back. And I'm looking at, go look at the healthcare, go look at the retail, go look at, even staples. Staples are discretionary. I'm looking at all those and I'm trying to find the things. So on a day like today, when people are realizing, oh, we got some WTI going back down to regular, look at booking.com, look at Airbnb, look at these travel stocks, Delta Airlines. Like, these stocks are starting to print some fresh highs in the last few weeks. And I think the money is rotating that way. We brought it up last week. I brought it up the week before. Like, I was very early on some of those ideas, and they're starting to they're coming back. So I had taken some off, but I kept some on, and that's coming back. So that narrative of maybe the consumer's back, maybe like things are okay, and yes, it feels scary when a sector is down 10% overnight, like the semiconductors. But look underneath the hood, look at the rest of the market. When you have breadth at 3 to 2, that's not selling. Like, it's long selling to buy other stuff.
Yeah. I mean, like I said, the issue is all that other stuff isn't as big as what's being sold. So you do end up with some cash on the side. And that's why you see red, and why we might end up rolling over today, even though market breadth is positive again. Now, I teased this yesterday, and I promised that we would talk about this.
Okay.
And I've named it the 3-step drop. And we were having a discussion at our traders meeting, and this is how you spot it's time to get the heck out of Dodge with a stock. And do you want to look at Micron? Do you want to look at SMH for this? So which ETF?
Yeah, it's funny. They both have like kind of the same pattern. So we can pull up SMH because it's an index, and indexes, they sort of, they're a little bit more stable. So I'm going to bust down you here for the chart a little bit. I'm going to get real picky about it. I probably should just show my own, but I'm on a laptop here. I'm up in Maine, and there. Oh, that looked good. Go back a little bit. I want to see. So when I'm looking at charts, you see that nice moving average kind of going up. No touch of the moving average. It's not touching that moving average. What term is that moving average? Is that your 21?
This is my 40 period SMA, and then the yellow is the 40 period EMA. So it's the 40-day moving average and the 40-day exponential moving average.
All right, I'm not going to bust on you. The 21 days is the one you're supposed to look at.
Here, I can pull that up on this one here.
So if you can, there you go, right there. Don't touch anything. This is amazing.
Day, the 50 and the 200.
Perfect. This is amazing. All right. So to the left of your screen, if you see a nice flat area, just leave it. Don't touch anything, Mark. To the left half of your screen, it's sort of consolidated and choppy. And then all of a sudden, mid-screen, that thing breaks out to the upside and starts going on a run. And it's off to the races. I mean, you can narrate this thing like a horse track, right? It's off to the races. It's going up. It's not touching the 90 moving average. It's rallying. It's heading to 510. Oh, we got a little dip. And it's going. So when you get to this moving average, and if you have, I like to look at a 9-day moving average and a 21-day moving average. And when those kind of split and go pretty parallel, we have no touch of the 9-day moving average. And that count gets big. It gets big. Let's say it gets over 9. Oh, it's over 10. It's over 15. When that thing is over 15, no touch of a 9-day moving average over 15, it is on like Donkey Kong. I mean, it is moving, right? It has not touched a 9-day moving average. People cannot buy enough of it. So I like to look at the first dip here. I want to try to find the first dip that I'm going to get to buy. I want to buy somewhere in around below the 9-day moving average, but still above the 21-day moving average the very first time.
That would have been May 19th or May 18th. Probably the 19th.
You're looking for a measured move. So if you go from the bottom, somewhere around 360 to 570, or call it 360 to 560, right? That's a 200-point move. I want to get somewhere around a 20% dip, right? So 360 to 560, that's 200 points. So I'm looking for 20% of 200, 40-point dip. Go from that high and then measure down 40 points. So 50,
So it's
50 80.
570,
580, right?
580.
580 minus 40, that gets you 540. So I'm bidding somewhere around 540. Oh, look at that. One day it traded. That's the bid.
Mm-hmm.
You bid there, you grab that, you exit the new high. That literally on the first dip, you got, I mean, you got one day, you were in, and then you're out within 3-4 days.
Yeah, you were.
It was
So you were buying on the 20th, and you were riding it all the way up to the 26th.
I did this trade in Micron. This is SMH. I did it in Micron. I literally got filled. I was out 2 days later. I mean, it was like, and if you didn't have the bid in, it was so fast you weren't getting filled. Now, you can keep following this chart. If it did not break the 21-day moving average, the trend's still pretty intact. So it keeps going. And it keeps going. All of a sudden now it makes another new high, pretty chunky amount of new high. Right?
Yep.
So the second time,
June 3rd.
you can still bid, but it's not quite as going to pay you instantaneously. Like it's going to chop a little bit the second time down, because the idea being of this idea of a trend pullback buy is that they're buying it, and nobody's bought enough of it yet. And so people are waiting to buy the dip. You have people short, so they're trapped short. They want to cover a short, so they're waiting for a dip to cover. And then you have people who want to get in, but they're waiting for a dip. So you get that first one. That's the kind of the theory on the first one. The second one through up to the new high, and then now you're getting a dip to pull back in the second time. You got to check yourself, because they're like, all right, people got to buy once. Do they still want to buy? And you got to ask yourself, do they still want to buy this? And so now you got to start to do some homework. Maybe you're looking at valuations. Maybe you're looking at the story. You're trying to figure out really what's going on. It's a little harder the second time. And this one worked the second time. It's a pretty strong rally. It's got a great story that was working out, and it went up and made a new high measurably. So it allows you to ask, all right, do I want to do this again? But the 21-day got broken. It closed below there. It settled. Now there's some sort of buyers meet sellers, a little bit of supply and demand equilibrium, if you will. And the third time, I don't know, man. This isn't like a rat trap. Like the third mouse does not get the cheese. It's like the first mouse, you get it, right? Second mouse, I'm not so sure. The third time, I don't really mess around with the third one. I kind of like, that's almost diverging. And that's when I'm starting to look for a short, right? So if I wanted to short Micron, or if I wanted to short SMH, I know you wanted to do this the other day. Great call. You were in. But I want to see some sort of divergence. I want to see some supply and demand, and I want to see kind of like a rollover. Because the thing that is super strong like this is not usually going to just collapse out of nowhere without a buyer stepping in to be like, I wanted some. I want to get in some.
Yeah.
And the same thing goes with if you just took this entire chart and you inverted the chart. And so when things are being sold and they're being liquidated to the downside, there's no reason to catch a falling knife. Just let it make a bottom. If you want to buy something, just let it make a bottom, let it diverge, and then come in.
Fascinating stuff. We're going to dig into finding some bottoms here maybe the next time I've got you on, and we'll go through that process. But, I think SMH down 7% in a single day is telling you that thing got a little too hot, and we're not in buy the day. The fact that it's flat today, that's telling you maybe don't buy the dip yet. Give this some time, folks. It's not. I'd rather buy it for 635 on its way up to 700 than try and buy it right here and watch it go to 530 before it starts to rally. So SMH, Jim's point is it's not time for SMH yet.
I'm not even looking at SMH. I'm literally not even paying attention. I mean, I'm looking at them because I'm seeing the money come out, and I'm looking other places because I feel like there's better places to be invested. I really think that portfolio managers are going to look around at valuations and say, well, I could buy travel stocks. I could buy these other things. I could buy all these other parts of the market have room to run upside where there's less risk. I don't need to have 70 vol in my portfolio. I can have 25 vol and still have decent upside. So that's
Yeah.
why I'm looking everywhere else. I'm long other stuff. I'm really not in the chip stuff right now.
I bought Wendy's for $6 yesterday.
Nice. Right?
No, I
Wendy's.
didn't.
That's awesome.
This is
Oh.
another Reddit squeeze that we're looking at here in Wendy's because
Oh.
so folks, we're going to be talking. I know many of you want us to talk about Wendy's. We're going to dig into what happened with Wendy's tomorrow. So make sure you're live with us as we are every single day here at 10 a.m. Eastern time. Tim, thank you so much for joining us today and spending some time walking through what you're seeing with chips, how the market is rotating. And I love the walkthrough on your 3-step drop. And we'll have you on to talk the 3-step pop next time. Can't wait.
Hey.
Folks, Tim Colby, everybody. All right. Don't go anywhere. Do not go anywhere, because immediately after I sign off, I'm going to be handing things to my friend Andrew Giovinazzi, and he is going to be talking about some smart, efficient ways to trade spreads. These have come up a lot because of SpaceX and because of the wild volatility in the market. They're the best way to take advantage of this market. So, Andrew, are you? Amin, do we have Andrew here?
Yes.
Hey, Andrew. Good morning.
How are you doing?
All right, folks. Andrew, you're going to dig into spreading and how to take advantage of this market. So I leave this amazing group of traders into your stern, safe, strong hands, the type of hands that can craft a canoe, can also craft a magnificent straddle, strangle, butterfly calendar spread. So I leave you in good hands, folks. I am Mark Sebastian. I am your only option. We'll be back with the state of the market tomorrow. Here is our own Director of Education and Head of Option Trading, Andrew Giovinazzi. Have a good day, everybody.
Wow, what an intro. Big, big, big. Yes, builder of chicken coops. If you hear a rooster, it's probably coming from me outside somewhere. Just letting you know. I mean, if you want to, well, welcome everybody. We're going to talk about spread trading today. Getting why? Why do you want to do it? What's a good one? What's a bad one? And setting them up. So this is like a little freebie for everybody here that's coming in Option Pit. We appreciate you coming. So these are the reasons. What I could think of is the easiest way to set spreads up, and why, and then how to set them up. So first, let's kind of get rolling with. There we go. Okay, so how many people in here have bought options before? Raise your hand. Like, hey, I bought options before. Okay. I bought options before. What are the problems with buying options? There's 2 ways your positions can fail, right? You are just wrong. You buy them and you're wrong. Wrong is no good. Way number 2 is the options decay faster than the stock moves. And then you go, ugh, okay. Either way, your position can go to 0 on you a little faster than you would like. So again, buying options, the leverage is great. The problem is being wrong on direction, or except for Alicia, because she really isn't, and then or the options decay too fast. So what you want to do is if you have a problem trading, you want to solve that problem. Then we have the third way, since I guess since Trump's been president, since he was elected, remember in January, everything kind of started last year with everybody remember DeepSeek, volatility blew up and things kind of just kept rolling from there. This is what I would call the tape bomb. And that's really been happening. Didn't really have them under Biden. We had them somewhat under Trump in the first term, but not to the level we have had this year. So the third way now is, and then just what is a tape bomb, right? Well, it's kind of this. So June 11th, this was going into a couple of weeks ago, right? The market was kind of, we were waiting for SpaceX, waiting for that to go live. And everything was kind of like, market was Then all of a sudden, well, okay, the Iran war is settled, subject to some finalization, member signing in a few days. Everything changed instantly. I am trying to remember, and again, put it in the chat, but when was the last time like so many big market direction swings coming out of what a president said? I don't remember that much with Obama. George W. Bush, no. Clinton, no. I'm really dating myself now. Now I'm getting back to George W. Bush. I wasn't actually, I was still in high school when Reagan was president, I guess. So that's as far back as I go. But from a tape bomb point of view, Herbert Walker Bush, there's a couple, right? We had the Iraq war. But anyway, like we get them with frequency now. Frequency. Okay. Here's another one. June 17th. Again, look at how the market is reacting. The problem with the market not going anywhere like that, when you look at it, is what? Options are decaying. You're not making any money when the SPY is just flat as a pancake. Then all of a sudden, boom. Okay. The Fed decides to change, right, the dot plots. No dot plots. We're going to be more dynamic. And traders and investors viewed that as, well, maybe there's no more QE. And again, you had a market that wasn't going anywhere, and then instantaneously we're down, 10, 11 points SPY. So the tape bomb is here to stay, at least for the next several years, as far as I can tell. So a way around this, okay, is setting up spread trades. So here's some of the, basically what, if you've never traded a spread before, and if you've never traded a spread before, drop that in the chat because you might have questions. But basically, it might sound weird, but you're doing a trade on two different strikes on the same stock, but you're buying one and selling another. And you're like, why would I buy one and then sell another one? It's all very confusing, okay? But it's really not. What you're really doing, you're betting that the stock's just going to move in a direction, but up to a point. So you can think of it as a built-in hedge. If you've never tried spreads, the reason that you do, and the biggest reason I think, is because you just think a stock is going to move to a strike. Now, I have a question for you. When you put on a trade, do you have an idea of where you want to get out of the trade before you put the trade on? I think that's a good idea because that gives you an idea whether you want to do the trade or not. But a spread is good if you're looking for a move to an area. Also, you need generally level 2 option clearance. So there's basically 3 levels of clearance. There's your initial one where you can buy stock. It's just like zero clearance. The second one is, which we'll call level 1, is you can start writing calls against your stock positions, what we'll call covered positions. Level 2 is spreads, where you can buy one option, sell another. And then level 3, you just sell up. You're allowed to just sell options. But most people with most accounts, margin accounts, and I don't mean margin where you have to take any margin, but you do have to have some kind of margin account in place for level 2. So again, think of it this way, is you're buying a call at one strike and then you're selling a call at another strike. Our ABC stock, we can't use XYZ anymore because that's a block, I believe now. If we want to buy a July 2nd 50-60 call spread, what do I think is going to happen? Okay. I don't think the stock is going above 60. I'm going to buy the 50 call. I'm going to buy where we are, and I'm going to sell where we're going to. It's the easiest way to think about it. Right? It can go up to 50, but if it goes higher than 60, I'll ask the question, if it goes through 60, is that a problem for the trade? If the stock actually moves farther than you think, is that a problem if you buy a spread? Right? It's still not a problem. The stock can still go up infinitely far, and your spread will still make money. And as a matter of fact, it will give you the max value. So you can still be right on direction. You were wrong that it just kept going, and you'll still make money. You won't make as much. You're just limited to how much you can make. You can only make the difference in the spread. Right? But you can get to 60. It can stop there, stop at 58, 57, and your trade can still make money. Your put spread is the same idea, but moving in the opposite direction. So again, you're thinking about, I want to buy a put where I am or close to where I am, and then sell the put farther away down. So remember, your puts, when you buy puts, you're expecting the stock to go down. In this case, you're going to buy the 40 put, sell the 30 put. And it's the same thing. If your stock goes to 0, you're still going to make money. Even though you blew all the way through the short strike, you're still going to make money, just not as much. And I will just let you know now, if a stock outperforms your spread, if you buy a put spread and it still goes to 0, you still made money. You still did the right thing. It's okay. When you trade options, if you make money on every trade, it might not be what you want, but if you make money on every trade, you're never really going to be sad, okay? If you're sad with the money you make, you might want to think about doing something else. Making money, trading options, that's what you're doing it for. Just don't forget about that. So you can go down to 30, you can rally even back a little bit, but the spread can still make money. So now the next question is, well, Andrew, I don't want to cap my gains. Why would I want to cap a gain on a trade? Now remember, the first reason was because I didn't think the stock could go up that far, right? Now here's, again, another example is you're trying to cut down your dollar risk, okay? You're trying to cut down your dollar risk. So if I just buy the 40 call, it's going to cost me $2.40. This is TAP Molson Coors, right? So apparently millennials aren't drinking beer anymore. So TAP is at an all-time low. This is not necessarily a trade wreck. However, right, when you look at stuff, I kind of look at, this is how I start to look at it. So, but the TAP 40-45 call spread is only $1.75. So if I think the stock can go to 45, right around there by an August expiration, spending less money by having a little built-in hedge makes it easier for your trade to make money, right? The less you spend, the easier it is for something to make money. It doesn't have to move as much, right? So the whole idea about trading any kind of spread is it should make everything cheaper for you. So it's easier for the trade to make money. So if you don't get the trade, you don't get the move, you only get a move to like 42.50, your trade still makes money, right? By expiration. And so again, the difference is you're trying to spend less money to make a little more money. That's the idea of a spread. Now, if you want to pick a spread, this is what I normally do. This is like basic spread trading. I don't know. I learned this like 35 years ago, I guess. Oops, sorry, I just got an alert. I don't know what it was. I'm going to guess it's SPY going up. And yep. And so people for weekly profit cycles, your stop should be hit. Sorry. The problem with a trader that trades in real time is, yep. Stop. I just got to send a note to everybody. All right. And Sorry about that. Anyway. Always when I'm doing something live. Has to be. Why can't I wait? Market's got to decide to do it while I'm doing things live. Totally annoying. Anyway, but the idea of picking your spread is you want to see what the market thinks is going to move. The easiest way to do that is look for what we call a straddle. Straddle is the call and the put value. So if I'm trading out to July 24th, the market is pricing, right, expecting, you add the call together and the put together, so it's about $14 each, expecting $28 up and $28 down. Okay? So I want a spread as wide as a straddle. I know that sounds crazy, but that's, again, you want to buy where you are and sell where the market thinks it's going to. So I'm looking for a spread here that would be right around $30, like the 175-200. Okay? The 175-200. 175-205, right? Because that's where you're looking for that move, and that helps you put your spread together. So again, you are trying to get the max dollars based on what the market thinks the stock can do. And in this case, the market thinks Reddit can move $30 between now and July 24th, right? Because every expiration will have a different call and a put value at the money. Makes it a lot easier to put those spreads on because it's giving you an idea where you want to place them. Right? Again, because you're going for trying the max gain you can get. If I move to $200, I want to make as much as I can for as little dollars as I can putting in. That's the idea. Okay? So the idea here, again, market's expecting $28 till the end of July. And in Rip Zone, we're going to take a look at that. Okay? Mostly because I think this stock's going to go up. But setting up the spread and setting up the trade, that's what we do in Rip Zone every day. So building our spread live here, is so how I would do that here, and I got to just do this real quick because I got kind of pressed for time here, but so if you have here's Reddit, and then we go to July 24, right? How you build a spread is, again, this is Thinkorswim, so it makes it a little easier. Right now we're trading around 165, so I'm going to buy one of those. And then I'm going to sell, I'll say like a 200, right? So right now, that spread's going to cost me, or you click your little, you could say, analyze a buy trade, a vertical. So if I go the 165, 200, okay, that's going to cost me around $10. So that gives you now also what it does is it's going to save me on theta cost. If I just buy the straight calls, those are going to decay at $288 per day for a 10 lot. Once I sell the call over it, I'm going to cut my theta literally in half. So the whole point of putting the trade on is now I'm saving a bunch of money on decay. As the stock moves up, the theta is going to drop, your decay is going to drop to zero, literally near zero. So as I go from 162 to 179, my theta drops from $153 a day to $28 a day. So what's happening is it's automatically dropping the decay for you as you move to the strike. So the whole idea about setting your spread up is we're moving toward that strike, and now all of a sudden my trade is no longer decaying against me. So the stock just sits there for a little bit and then decides to make its move higher. You're still going to benefit from that. All right. Now, when not to use spreads. Okay, this is a couple of tricks for you here. right? When volatility is too low. So when option prices are too cheap, I think it's just better to just straight buy the option prices and buy a little more duration. Don't bother with spreads. Okay. Low priced options are not worth selling because they really never decay very much. I think it's easier to buy calls, straight calls and puts instead. So when volatility is low, add more duration. The second part where I don't think spreads are great is when the stock volatility is very high. Basically, you put your trade on calls or puts, and then all of a sudden, boom. Okay. The stock is moving around so much, you want to exit faster. So anytime you want to exit faster, spreads are not necessarily the best thing. Especially when the volatility is very high, because you're not going to be holding the option long enough for it really to decay in a meaningful way. So I think they're a little less useful for short-term trades in high vol environments. Basically, I want to put your trade on underlying moves, and then you sell it. Now, why is now a good time to use spreads? Well, because we're in tape bomb area, so we're waiting for always the next thing from coming out of the White House. So what's happening is by buying spreads now, you basically are saving money. You have a lot less decay coming in until something happens. So when you have that environment, you're basically not overpaying and you're waiting for the unexpected. So that's why now is a good time, right? VIX is trading around 18 instead of 12. Now, you want to learn all this? If you want to take all this stuff and learn it and help your trading, you can do that in the RIP Zone. We meet every day at 11 o'clock. And right now we're doing a monthly membership. So if you want to learn about options like this, learn about trading spreads, how to use spreads, set them up, close them, open them. I just gave you an example. People in weekly profit cycles, I just let them know we hit a stop, so we want to take some profits on a put spread that we own. Okay, put spread. It gives you an idea of how to put trades on. So we look at volatility trades every week when there's trade. We have volatility trading guides. Also, I do class notes every day. So you have class notes. You can see all the things that we talk about. I read it down. 25 hours of educational content on all of the volatility products. Plus, we also do vol trades on equities. Okay. So that's $299 for a monthly membership and intro offer if you want to try it. So call support 888-872-3301. MMM, same thing. Lots of great info in the RIP Zone. Can you or should you close one leg earlier? What I would always recommend is if you want to close a leg earlier, close the short leg. Because if you close the long leg, you're left with a short option contract that can make you very sad. So you can always close a short leg early if it makes you some money. But after teaching traders for the last 15 years, people can get in bad trouble closing the long leg and then leaving the short leg open, and then it blows up in their face. So closing short legs, good. Closing the long legs, bad. Okay. So anyway, you can pop into RIP Zone today if you join. Monthly membership is $299. Also, if you call support 888-872-3301. If you like a yearly, if you spent $299 a monthly and you want to roll that into a yearly, give them a call and let them know. So anyway, check it out. I believe there are links at the top if you want to join. So click the link. Also, State of the Market will be back here tomorrow. Also with Garrett, I believe, at like 9:20 or something. So you got about an hour of we'll call it educational content in the morning. But Rip Zone is going to start right after this show, but I got to hop to it. I also got to close my put spreads as well in SPY. So anyway, for Mark here at Option Pit, for myself, if you want to learn how to spread, use different kinds of spreads, trade volatility and trades vol on equities, Ripzone is a great place to learn all that stuff. All right, it's $2.99 a month for a 1-month membership. It's a special right now. Give it a try, and I'll see all of you in there hopefully in a couple of minutes. All right, I am done. Thank you very much, everybody. Check the link up above.